Good morning, everyone. This is Dana from NexGen, and I hope everyone has had a fantastic week thus far. Today, I would like to talk to you about using personal credit cards and getting their maximum use. On the statement that I'm going to share with you today, this person actually used their credit cards for everything that they could, with the exception of those that either did not accept credit cards or they accepted the credit cards with a fee. So what you'll see is how the person applied their payments to the credit cards. I will show you how the person not only pays no interest, but how they reduce their credit utilization to increase their credit score. We're going to go over a credit card statement. Now, this is just a portion of the credit card statement. The part that you would concentrate on first would be all of the charges. So you would want to make sure that all of the charges and the credits are appropriate. And you could either do that online before you get the paper statement, or a lot of times after the statement closing date, that's when in a lot of cases you will be able to dispute charges if you need to. But what we're going to do today is we're going to concentrate on the top portion. We're going to look at the total credit line, the statement closing date, and the payment due date. And I'm going to show you why this is important. So on the total credit line in this example is $7,000. And the reason why that's important is because in this scenario, you want to make sure that you do not come close to the credit limit of $7,000, especially if you're going to carry a balance. But if you're not going to carry a balance, you still want to make sure you do not come close to that credit line. In this sample, we are using the days in the billing cycle from September 19th through October 18th, 2023. So the previous balance was $2,550.85. That was the previous balance. Then what is reported are the payments and other credits. For example, if there was returns, if there were rebates, all that would be taken into consideration and subtracted. Then after that, you have the purchases and adjustments. So with the payments of $5,554.98 subtracted, then you're adding in the purchases of $3,578.92. The difference is $574.79. So if you add the previous balance and the purchases, then you would have $6,129.77. Now, what I want you to pay attention to is the previous balance was $2,550.85. That was the previous balance, and probably the minimum payment due would be $25. So let's say that this person only made the minimum payment. Then their total due would be the $6,104.77. And in this scenario, that would be coming close to the credit line. So that's why I was showing you that it's in this scenario, the person took their paycheck and applied everything to their credit card. So with the previous balance, then the payments, then add back in the purchases, the new balance is now $574.79. And the statement closing date is October 18th, 2023. And there's something significant about that closing date. So what we're accounting for is everything that occurred on or before October 18th, 2023. Now, in the previous statement, with the previous balance of $2,550.85, that payment, whether it be the minimum payment due or any payment, would have been due probably October 15th, 2023. So there is a 3 to 4 day difference between the due date and the statement date. And this is very important. So what do you think the credit card company is going to report to the credit bureaus? They're not going to report the purchases of $3,578.92. What they're going to report is the $574.79. So they're reporting that amount, and with the available credit of $7,000, and you can see that is well below the 30% utilization rate. So that's why it's important to apply as much as you can to include paying off the credit card balance on or before the payment due date, not the statement date, the payment due date. So in this case, with the $574.79 balance, they're showing a current payment due of $25. And that $25 is due November 15th, 2023. So after October, so that's what's going to be reported. But there are going to be purchases that are going to be made after October 18th, 2023. But those purchases will not be due until December 15th, 2023. So that's why this person made a point of making their purchases, especially their larger purchases, after the statement closing date, because that would actually push the payment due date further out. And I hope that was clear to you, to make sure that, one, you pay attention to the payment due date. So any balances you have on the statement. So if there's any purchases after that, this person would only be concerned with making sure that at least either the $25 or the $574.79 is paid in full before November 15th, 2023. The next billing cycle will probably be November 18th, 2023. You will also notice that there were 0 fees charged and 0 interest charged, and that is very important. All right, so let's go ahead and wrap up what we have gone over today. The very first thing is we do not want to exceed the credit line, and it can change. So you want to make sure you're paying attention to that credit line. And at the same time, you're making sure you're monitoring your credit card to make sure there are no unauthorized transactions, whether they be purchases or anything else. You want to pay at least the balance due in full. Now, definitely you want to pay the minimum payment due, but for this to work, it's in your best interest to pay the new balance. Now, there are going to be other purchases after the statement date and in this scenario, the person applied all of their pay to the credit card. Of course, that is your decision, but this is to reduce the interest, if you're paying interest at all, to pay at least the balance in full. Any charges that are made after the statement closing date, it will be applied to the next bill. And the new balance, which is the $574.79, that is what is reported to the credit bureaus. Now, the person could have paid the entire thing in full and had it to zero, but they chose not to. Definitely their call. And unless otherwise stated, there is no grace period for cash advances or balance transfers. So what I was talking about here are for purchases, but the interest will start, unless it's otherwise stated, on cash advances and balance transfers at the time they occur. So make sure that you review your statement and your contracts to make sure when that would apply. So hopefully this information was beneficial to you. If you have any questions, please put them in the comment section below. And don't forget to like and subscribe and share this information. Talk to you soon.